Welcome back. I'm John AG, and today is not a normal dip show. This is the kind of session where the screen looks red, the comments get loud, and everybody suddenly wants a clean answer. Is this weakness real, or is the market being shaken before the next move? Because gold and silver did not just slide, they were attacked in layers. First the futures pressure, then the options pressure, then the Fed pressure, then the energy headlines, then the usual panic voices saying the trade is over, now slow down. A red candle does not automatically mean the bull market is dead. A pullback does not automatically mean the physical story disappeared. And a scary open on COMEX does not automatically mean every stacker should throw away the plan. Before we go deeper, do me one favor. My stats show a lot of you watch these videos but have not subscribed yet, so subscribe. And comment "Our John AG" or even one sharp thought below, so the algorithm knows this content has real value. Alright, let's separate noise from structure. The first thing to understand is timing. COMEX metals do not trade in one endless straight line. Silver futures trade nearly around the clock from Sunday evening to Friday evening, but there is a daily 1-hour break beginning at 5 p.m. Eastern before the market reopens at 6 p.m. Eastern. That reopening matters because liquidity resets, new orders hit, overseas traders react, and the first candles can look more dramatic than the real underlying move. So when silver is sitting around the low $70 area and gold is hovering near the 4,600 area, the question is not simply, are we green or red? The real question is, who is selling, who is forced to sell, who is buying quietly, and who is waiting for delivery pressure to show up. That is the difference between price action and market structure. Now, the source notes showed silver down more than 3% and gold down almost 2% during the session. Fine, that is a nasty day. But nasty days inside a powerful market are not rare. They are part of how leverage gets cleaned out. The fast money comes in late, gets excited, overextends, then gets squeezed by margin, expiry, and headline risk. The physical buyer does not always panic with them. The physical buyer often waits. And that is why I do not want to scream shortage every time silver sells off. I also do not want to pretend everything is normal every time the price bounces. Both mistakes lose people money. This week is dangerous because several clocks are running at the same time. The Federal Reserve has its April 28th and 29 meeting, with the rate decision and press conference scheduled on April 29. That means every word from the Fed can hit the dollar, bonds, gold, silver, and risk assets within minutes. If the tone is hawkish, metals can get smacked. If the market hears even a hint of future easing, the same metals can reverse hard. That is why this is not a casual week. It is a positioning week. Then you have inflation and growth data. Core PCE, GDP, and month-end chart positioning all arrive when traders are already nervous. A monthly candle can become a battlefield, not because candles are magic, but because funds, algorithms, and technical traders all see the same levels. Everybody watches the line. Everybody acts around the line. Then people act surprised when the line matters. But the bigger issue is silver itself. The Silver Institute has already acknowledged that the silver market is expected to remain in deficit for a 6th consecutive year in 2026. That does not mean there is zero silver. It means demand is still projected to exceed fresh supply, and inventories have to absorb the difference. That is a completely different conversation from social media panic. It is not about one vault report. It is about a multi-year draw on available metal. Now, the vault talk needs discipline. Registered silver and eligible silver are not the same thing. Eligible metal meets exchange standards and sits in approved storage, but it does not have an active warrant. Registered metal is eligible metal with the warrant attached, meaning it is ready for delivery through the exchange. When metal moves from registered to eligible, it can be part of a withdrawal process, but it does not prove the metal already left the building. That detail matters. So if somebody shows you one number and says, "This proves COMEX is dead tonight," be careful. If somebody shows you the same number and says, "Nothing matters," also be careful. The truth usually sits in the mechanics. What I want to watch is not one dramatic warehouse line. I want to watch repeated drawdowns, registered inventory pressure, delivery demand, open interest into notice periods, and whether eligible holders are willing to convert metal back into registered supply when the market needs it. That is where stress becomes measurable. That is where the story either gets real or gets exposed as hype. And right now, the story is not dead. It is just volatile. Gold has its own engine. A major bank recently modeled a scenario where gold could reach $8,000 within 5 years if central banks push gold toward a larger share of global reserves. Now listen carefully. A scenario is not a guarantee, but it tells you something important. Gold is no longer just a retail fear trade. It is being discussed as a reserve asset in a world where trust in currency management is weakening. That is the real macro picture. Debt is not shrinking. Deficits are not disappearing. Governments are not suddenly becoming disciplined. And when confidence in paper promises starts to wobble, gold does not need a perfect news day to matter. It only needs people to ask one question: what asset has no central bank liability attached to it? Silver is different. Silver has the monetary story, but it also has the industrial story. Solar, electronics, grid build-outs, defense, medical, and investment demand all hit the same small market. But silver also has a ceiling mechanism. High prices encourage recycling, thrifting, substitution, and demand delays. That is why silver can move like a rocket and still correct like a trapdoor. So no, I am not telling you every dip is free money. I am saying the dip needs to be judged against the structure. Now let's talk energy, because this is where metals traders sometimes miss the second-order effect. The UAE has announced it will leave OPEC and the broader OPEC Plus framework effective May 1, 2026. That is not a small headline. It weakens the appearance of cartel unity at the exact moment energy markets are already dealing with war risk, shipping disruption, and inflation pressure. Maybe oil falls because more supply can eventually come outside coordinated quotas. Maybe oil spikes first because the system sees fragmentation during a crisis. Either way, volatility rises. And volatility is oxygen for gold. Then comes fuel policy. The EPA issued an emergency waiver allowing E15 gasoline to remain available beginning May 1, 2026. On the surface, that sounds like relief at the pump. More fuel options, more supply flexibility, maybe less pressure on drivers. But the second-order questions matter. What vehicles are compatible? How much corn demand moves into fuel? Does that pressure food prices later? Does lower gasoline today create a different inflation problem tomorrow? Markets do not move on the first headline. They move when the second and third effects start showing up. Now add Iran-related sanctions. The U.S. Treasury announced sanctions on 35 individuals and entities tied to Iran's shadow banking network. The target is not just politics. It is finance, oil flows, refinery networks, and the channels used to move money around restrictions. When sanctions hit energy-linked financing, metals traders pay attention because oil, inflation expectations, currencies, and safe haven flows are all connected. So when somebody says, "Why are gold and silver not exploding today?" my answer is simple. Markets do not always react in the order you want. Sometimes war news hits and metals drop because leveraged traders need cash. Sometimes the dollar jumps first. Sometimes margin pressure beats fundamentals for a few sessions. Sometimes the correct thesis gets punished before it gets paid. That is why you need time frame discipline. What is a trade? What is a position? What is insurance? Do not confuse those three. If you are trading futures, your enemy is leverage. If you are stacking physical metal, your enemy is impatience. If you are using gold and silver as insurance, your enemy is overexposure, because panic buying at the wrong moment can make even a good asset feel miserable. This is also why I keep saying, share your real wins in the comments. If you bought early, built a position slowly, avoided leverage, or survived a shakeout, tell people how you did it. New viewers need to see that success is usually boring before it becomes impressive. Now back to the market open. The first move after reopening can be a head fake. A fast green candle can pull in late buyers. A fast red candle can scare out weak hands. But the real question is what happens after the first emotional move? Does silver reclaim levels? Does gold hold above the prior support zone? Does volume confirm the move? Or is it just another thin session sweep? That is where patience beats adrenaline. There is another trap here, and it is the screenshot economy. People grab one chart, one vault line, one dramatic headline, and they build an entire end-of-the-world forecast around it. That is not analysis. That is emotion wearing a suit. A real setup needs layers: price, volume, delivery behavior, macro pressure, physical availability, policy risk. And then, after all that, you still need humility, because markets can stay irrational longer than your conviction can stay funded. So when I see a sell-off into a packed calendar, I do not automatically call it manipulation. I ask who benefits from fear. I ask who needed liquidity. I ask whether the sellers were strong hands changing their mind or weak hands getting removed. Those are two completely different events if the candle looks the same. And remember, the biggest moves often begin after the crowd is tired, not when everyone is cheering, not when every comment says moon, not when every thumbnail is screaming emergency. The move that matters starts when people stop caring, when leveraged traders are gone, when the physical buyer has been collecting, and when the next headline suddenly hits a market with fewer sellers left. That is the zone we need to respect. Not worship, respect. Because if silver breaks higher from weakness, people will say it was obvious. If it breaks lower first, people will say the thesis failed. Both reactions are simple. The smarter question is whether the long-term pressure is getting stronger or weaker while the short-term chart is making noise. The competitor style online will always be louder than the truth. One side yells that COMEX dies tomorrow. The other side laughs and says physical metal does not matter. I think both are lazy. COMEX matters because it sets price discovery. Physical metal matters because price discovery eventually has to meet delivery reality. The fight between those two forces is the market, and that fight is exactly why silver is so violent. Gold can trend with dignity. Silver rarely does. Silver squeezes, flushes, pauses, fakes out, and then moves when the maximum number of people are emotionally exhausted. That is not a bug. That is the personality of a smaller, thinner, more leveraged market. So what should we watch next? Watch the Fed language. Watch the dollar reaction. Watch real yields. Watch silver open interest into delivery windows. Watch whether registered inventory keeps falling or gets replenished. Watch ETF flows. Watch Indian demand if prices stabilize. Watch recycling, because high prices invite supply. Watch energy headlines, because mining does not run on hope. Diesel, power, financing, and asset supply matter. And watch sentiment. If everybody is euphoric, risk rises. If everybody is depressed but the structure is still intact, opportunity can quietly build. Now, I want to be careful. This is not financial advice. This is market observation. You decide your risk, your time frame, and your position size. But do not let one red session erase months or years of preparation. And do not let one bullish headline convince you to abandon discipline. That is how markets take money from impatient people. Here is the clean read. Gold is still supported by reserve demand, debt anxiety, currency distrust, and geopolitical uncertainty. Silver is still supported by deficit structure, industrial demand, investment demand, and physical tightness risk. But both metals can still sell off hard when leverage gets cleaned out, when the Fed sounds tough, or when traders rush into cash. That is not contradiction. That is markets. So tonight, when COMEX reopens and the candles start moving, do not just watch the price. Watch the behavior. Does selling get absorbed? Does the bounce hold? Do bids appear after panic? Are the same levels defended again and again? Are physical stories confirmed by actual pressure, or are people just reposting dramatic screenshots? That is where the signal lives. And one more thing. If you are already successful in this market, do not disappear silently. Drop a comment and tell the community what helped you win. Not to brag, to raise morale. Somebody watching right now is one bad emotional decision away from blowing up a good long-term plan. So, did you buy the dip, wait for confirmation, or stay completely out? And which signal matters more to you this week? The Fed, COMEX delivery pressure, or energy headlines? Put in the comments. I want to see where this community stands. Because the next move may not come politely. It may come after a fake breakdown. It may come after a hawkish press conference. It may come after one more liquidation candle that makes everyone say, that's it, the run is over. And then, if the physical bid is still there, if reserve demand is still there, if energy stress is still there, the market can turn faster than the crowd can process. That is why I am not sleeping on this setup. Red candles are information. They are not instructions. Green candles are information. They are not permission to get reckless. The job is to read the structure, respect the risk, and stay alive long enough for the bigger thesis to prove itself. Subscribe if you value sharp market breakdowns without the nonsense. Comment "Our John AG" if you are still watching, and I will see you in the next update.